Hey everyone, welcome to my channel. My name is Zach and today we are talking about my final warning about passive investing. This week has been a really tough week for our portfolio, so I'm going to do two videos this week. One on this, which I really need to talk about, and another video following up on the performance of the portfolio, which hasn't been so good this week. So I really need to warn people about this phenomenon that's happening in the market. And people may think I'm crazy, but that's okay, as long as I give you fair warning and you can make your own decisions from that. Remember, none of this is financial advice, so do seek a financial professional should you need help with these concepts as well in your investing process. There is a huge problem with the way that passive investing is being done, especially for those who invest in the S&P 500 or the Dow or the NASDAQ 100. Now, I wish I could take credit for this concept, but I didn't invent it, nor did I even find out about it. I just happened to hear about it from listening to very many podcasts that I listen to all the time. So if you YouTube Mike Green Passive, you can find a lot of interviews done by Mike Green, and he is the one who really put me onto this. And he's been talking about this for actually a long time. In fact, here's one interview of him doing this like 4 years ago. That if you invest like $100 in the S&P 500, that your money will be split into like the different stocks within the 500 portfolio, which is correct. But in an equal weight portfolio, what will happen is that each stock will get $25 each. But the S&P 500 is not equal weight. Instead, it's what's called is market cap weighted. So in the same scenario of $100, and let's just say this stock is worth 10 billion, stock B is worth 8 billion, stock C is worth 2 billion, and stock D is worth 5 billion. 5B, 2B, and 10B. What will happen is that you take the total weight, which is 25 billion, and allocate more money to stock that's worth more. So in this case, the 10B gets the most, so this gets $40 off your $100. Stock B gets 32, 8, and 20. So what you can see from this is really that the larger cap, or the higher the market cap is of the stock, the higher your allocation is. And market cap is really just showing how large a company is, right? So the larger the company is, the more allocation you're going to have to that particular stock. So what has happened over the past few years is that when people moved into passive investing through things like tax efficient investing, pension investing, things like that, you now have a market that keeps allocating more and more to the larger stocks. And this culminated in a problem we call the Magnificent Seven. And the Magnificent Seven are really these stocks, so Apple, Tesla, Meta, Google, NVDA, Microsoft, and Amazon. And last year, what you can see is that this orange line represents the Magnificent Seven that has gone all the way up, and the rest of the S&P 500 really didn't move. So basically, these 7 stocks, which I just showed you, contributed to most of the move in the total S&P 500 return. Now, why is this bad? Because passive investing tends to be a very, very simple algorithm. You give me money, I buy. You take away money, I sell. So because of this weighting over and over again to the larger and larger cap stocks, we've come into a market that seems very disjointed. Okay, as you can see here, Microsoft, NVIDIA, Apple, and Amazon really contribute to a huge portion of the S&P 500. And really, this recent rally of the last 2 or 3 weeks has just been driven by NVIDIA, Microsoft, and Apple. So this problem is also known as breadth of the market, means like how much of the other stocks are really joining in the rally. And it's really become quite bad. If you look at this, which is a comparison of an equal weight versus a market cap weighted, you can see the S&P 500 performed plus 36% in this time period, and the equal weight only did 18%. So that's an almost 20% underperformance by the equal weight. Now this really concerned me this week because when Apple made an AI announcement, the stock jumped 7%. And of course, because of this weighting that we see, the index also went up by a lot. However, the other stocks in the S&P 500 didn't do as well. In fact, a lot of them dropped. So now we're seeing this disconnect between these magnificent 3 stocks, and the rest of the index and the overall economy. What I'm really concerned about is the complacency of the market and how everybody expects the index to keep going up despite these imbalances in the market. And where there's imbalances, there's one opportunity and two huge amounts of risk. So lastly, I just wanted to show you a clip of why I think that the tide might finally be turning for the S&P 500 as an index as a whole, and why I think you should be really, really careful about just investing the S&P 500 and doing passive investing. Real quick, before we get to the video, if you enjoyed any of this, do check out my portfolio on eToro and the links in the description below. Do sign up for a virtual account just to test eToro out for yourself and see if this is something that you might be interested in. I help people manage their money using the copy trade function on eToro, but it's also a great platform for you to explore different trading styles, explore different instruments, and overall have a great experience.
Do that we're just
well, let me steal from you for a second and give you one that I think is actually the really important one. And so I'm just going to share one more slide for you, because this is really why I think a lot of this matters in a pretty meaningful way. People that have listened to me in the past have heard me talk about the bid for passive and the structural dynamics of money flowing into 401ks. And I just want to emphasize and highlight for people that we're actually now starting to see what I was worried about, which is the signs that the market is hitting a point at which the flows into these strategies are beginning to slow and turn negative. And I'm going to use two different slides here to show this, just so people are aware. 401ks, which are the savings vehicle, those almost exclusively flow through mutual funds. We're actually seeing signs that those are beginning to turn negative in the mutual fund side.
All right, and why?
Simply because the aging of the baby boomers, they're moving out of the retirement system, they're beginning to draw down the system. It's just a numbers game. And the last thing I would just highlight on that is, remember that withdrawals are always a function of wealth in a 401k. It's how much is it worth? Contributions are always a function of income. So when assets rise faster than incomes, withdrawals will cross over this point faster than they otherwise would. Right, so that's part of what's ultimately playing out here. So this is a demographic feature. This is the same deterioration that you're seeing in the U.S. financial budget, fiscal budget, if you exclude the interest rate increase. And that mutual fund downturn has been offset up until this point by ETF growth, which is money that's reinvested. It's unusual to see those in things like 401ks. If I combine those two on a dollar for dollar basis, we're actually seeing that slow and turn negative for really the first time since the start of the pandemic. And this appears to be much more structural in its feature. This is what I'm scared about. This is what I'm worried about, is when those passive vehicles that operate off of those super simple models, if you give me cash, then buy, if you ask for cash, then sell, we're starting to see the signs that they're being asked for cash.
All right, this is huge. So you have talked about this, or referred to it, I believe, in the past as the giant mindless robot, right?
Yep.
And this has been, you think, a large, perhaps massive contributor to how financial asset prices, stocks, most importantly, have just been grinding higher, particularly a certain part of the stock market, right? The Mag 7, right? Yep. The stocks that get an unfair share of every new dollar contributed to the market. And as long as those passive inflows, those capital inflows continue to be net positive, then the math basically says, well, then stocks have to go up, right? And your fear has been, if those capital inflows begin to turn negative, you have that same phenomenon just in reverse. And if this begins to happen for a structural reason, then we basically are in danger of a big unwind of a lot of the stock market prosperity that we've seen, say, over the past decade. True?
Unfortunately, that's a correct interpretation of my fears.
This is not to say I'm right, or this is not to say Michael Green is not right, but it is very concerning and a huge overhang in the risk, because if this turns, it can turn very, very quickly, and just being notionally exposed to the S&P 500 means you can take huge losses. This is one of the reasons why I don't hold any Mag 7 stocks, and I don't hold the index fund as a whole. In fact, I don't even like to benchmark myself against the index.